Welcome to Weekly Diagonal Spreads for Consistent Income. Again, my name is Doc Severson, and you are with TheoTrade for tonight. So, folks, this is our risk disclaimer. What it basically says is that you'd better respect trading through risk management and treat it like a business, or it's going to be the most expensive hobby that you'll ever have. So I'm not going to go into every line here. You guys are big boys and girls, you get it by now. So let's move on. Now, who on earth is this Doc Severson guy? Well, look at the shine on that head. I've just come out of the waxing booth there. I am a poster child for Rogaine. A little word of work on the side. I am an options and technical analysis content provider for TheoTrade. I have been here since the March timeframe, and it has been a pleasure. So you may have heard my stuff before around the world. I've been doing this now for quite a while, 20 years of trading experience. I've been mentoring people for the past 11 years and never intended to get into this. I was forced into this at gunpoint, but it's actually a lot of fun and I really enjoy doing it. I've actually been working with thinkorswim for about 10 years now, so that comes in handy from time to time, as it is currently my favorite platform to use. And about a year ago, I finished my book, which was Hacking the Holy Grail on Amazon. So it's out there if you want to have a read. Okay, so that's who I am. What about the rest of our team? Well, hopefully you've heard of Don Kaufman, who is the co-founder of TheoTrade, has been trading for 18 years and has turned trading into a spectator sport. Hopefully you've gotten a chance to listen to Don at this point. Truly a pleasure to work with him. Jeff Bierman is probably one of the smartest and most erudite individuals that I've ever run into, especially as it relates to technical analysis. He's been trading for 24 years, and it seems like he's got more experience than that. Steve Slim Miller, we call him Slim because his initials were SLM on the floor, has been trading for 42 years. And that means that he's been trading ever since he was 3 years old. He is quite a resource, and you'll see him on TheoTrade as well, too. Tony Rago is our NQ, or NASDAQ futures expert, and is on pretty much all day calling out trades, and he's got a session for an hour a day. We also have Theo Dark Economic Articles by John Galt. Now, if you ask the question, who is John Galt, you're my kind of person. So John Galt has great articles out there that will make you think from a different perspective on this business. So that who the team is. We've been going since the beginning of this year and already have got an enormous amount of momentum and content out there. So the question that we always say is, why pay? Free is better. So nobody should be charging you for technical chart studies or anything else like that. We don't sell indicators out here. So we at TheoTrade have set out to provide you with the latest, most effective studies with no pitch, no catch, no cost. Save your money for trading. Hope you learned something tonight. So tonight, WIFM means what's in this for me? What's in this for me? That should be what you should be asking at this point right now. Why am I here and what am I going to get from this? So what you're going to hear about is what is the current character or state of the market right now? What option strategies should I be using for today's market? We're going to get into some basics about time spreads. I'm going to assume that most of you know something about time spreads out there. I'm going to give you a little bit of different twist on time spreads tonight. I'm going to talk about increasing your edge for timing entries. So we're always trying to time our entries a little bit better. I'm going to show you a different way to do that. I'm going to show you how we can scan for candidates and use the system to do that, so we're not out there just staring at charts all day long. And then ultimately wrapping all this together and building a trading framework for what we do. And then we'll finish out today with going over next steps. So tonight, that is our WIFM. That's the what's in this for me. And we're going to cover all those things in the next few minutes here. So Again, I go fairly quickly, so yes, you will get a recording of tonight's session. I'm going to go very quickly, like I said, so we get to everything, and I want to respect your time. If you could, please hold your questions until the end of today's session. So what I find is that if I start answering questions, which I love to do, but if I start answering questions in the middle of the session, I tend to get derailed, and I tend to run down rabbit holes and things like that, and people don't like that. So I want to respect your time and get to the end as soon as we possibly can. So if you have any admin questions or anything that's specific to the technology that we're using tonight, we do have staff online that can answer those questions, but anything regarding the content, please hold on until the very end, and we'll spend as much time as we need to answer all your questions. Okay, so here we go. What is up with the current market? What is up with the current market? Is this the Trump rally, is it on, or are things just about to get interesting? I think it may be a little of both, right? So finally, this election cycle is over. Did we ever think that we were going to get this thing done with? The market appears to be celebrating at this time, all right? No surprise. The S&P is near all-time highs, and many other indices are in full-on rally mode. Right? So we have the Russell up at all-time highs. We have the Dow Jones transports finally starting to come out from underneath the curb here. They've been underwater for so long. And even the Dow is up at all-time highs now. Volatility futures are diving again, so the coast is clear, right? So we have no risk going forward in the future, right? Well, here we go. Complacency rules again, right? Where have we seen this picture before? So I am not going to get into politics tonight. I swear I'm not going to get into politics, but we are going to speak as adults here and talk about the factors that will affect things, right? So we can do that. We can be big boys and girls here. So yes, Trump should be growth friendly. Trump should be growth friendly. Trump should be easing regulations. He's going to be focused on, the other day there was a question from him about what he was going to do in terms of appointing a special prosecutor for Hillary. And he said, no, I want to focus on jobs. So the market receives things like that very well. So he should be growth friendly. But how often has he shifted his stance? Again, this is not a criticism of him. It's just he's a business guy, and he has been able to, in the past, be flexible, change his mind, and do whatever he wants to support his business. And all of a sudden, you can't really get away with that anymore. You can't be one thing one week and then shift your mind and say, well, that was last week. I think I'm going to think this way this week. That's going to be difficult to carry off, right? If you're the president of the United States. So he has a history of doing this. And do markets like uncertainty like that? I don't think so. So I'm a little concerned about this, is that he may take him a while to get into the groove here. He has also publicly gone after the Fed. He has already publicly said that he was going to fire Janet Yellen. Okay, I'm not saying that that's necessarily a bad thing, but Fed actions are the one constant that traders have come to rely on over the past decade. So as much as we gripe and bitch about the Fed, it is certainly one constant that we've had. We've always had one body to look to grumble about, but at the end of the day, I think the market overall looks at the Fed with a sense of certainty, right? They're very rarely do they come out with something where they say, well, where did that come from? These guys are telegraphing things from 3 miles away before they finally act, which is not necessarily a good thing long term. But it is what it is, right? Another question here. What happens when two-term presidencies end? And you can see them in the red circles here. Now, keep in mind, this is from Zero Hedge. You read Zero Hedge for a couple of days and you're about ready to jump off a cliff. But this is factual. This is true. This is when two-term presidencies end, usually the market has some difficulty with that. All right? So that's just a fact. That's not opinion. So you can also see if we just pull out the S&P, since this is almost 100 years of the S&P here, the past 20 years or so has been especially volatile. This is not a log scale. This is a linear scale, and you can see how things have changed really over the last 20 years or so. And a lot of this has been due to printing and M2 and currency debasement. So it's just a different world, right? So the higher they are, though, the harder they fall. We got much more volatility now. So what's my point? Well, we're in the first week of the honeymoon. We have a long way to go, guys. I think that there's a very high probability of reactions as uncertainty comes into the market over the next few months. That should be no surprise to anybody that's been around for a while. Okay, so we're in the honeymoon period. It's been a week. Everything feels great. Market's going higher. But in the back of your mind, you know that this is not going to last. You're going to have your first argument at some point during the honeymoon. And how do markets react? When in doubt, palms out, time to sell. So we've had two limit down events already this year alone, 5 months apart. How often does that happen? Not too often, right? So anything that we trade from here on had better anticipate these movements so that you can manage your risk. We need to anticipate this sort of stuff. Range contraction like this leads to range expansion, as we'll go into in a little bit later. So we need to start trading the strategies for today's market. Not necessarily the one from 3 months ago or 6 months ago, but we need to look forward. We need to anticipate what we expect to see. And I just don't see this as being anything other than some form of chaos. Even if we end up going higher, there's going to be more realized volatility. Okay, so hopefully you agree with that, right? So if you don't, that's fine. But, oops, there we go. So what are the strategies that we're going to be using for today's market? What do? Just buy call options? If we anticipate chaos, or just buy put options, selling? There's got to be ways that we can intelligently apply this to the strategies, right? So let's summarize the current state. Currently, this is a very low volatility environment. We lost 7% on the VIX alone today, which is 30-day vol. We do have start and stop trending now. What I mean by this is that generally we are moving higher, but what we see is typically a lot of this, breakout and then consolidation, and then breakout and then consolidation. A lot of start and stop trending. So it's not just a one-way, it's just not a one-way. This is not 2013 again. It is still a persistent uptrend. You look at the monthly chart and we're still in an uptrend regardless of whatever index you look at right now. We have very strong potential for very violent downdrafts like what we've seen lately. Again, limit down that's no joke, right? Limit down can lead to more limit down. And think about this for a second now. Violent downdrafts are going to favor long Vega strategies. Oh no, he whipped out the Greeks. What does that mean? Long Vega means any strategy that favors implied volatility on a net basis going higher. So just think about it that way. Long Vega, this is not the very, very bad Chevrolet car. Long Vega means sensitivity to implied volatility. Long Vega means generally going up, right? So the position gains value as implied volatility on a net basis goes up. Okay? So the challenges to typical option strategies are long calls. Okay, we don't have to go into very long on this one. Long calls get chopped up, get crushed by IV, right, or destroyed on the downdraft. We're not trading this anymore, I hope, right? Iron condors get run over on one leg, then the other. I mean, what we've typically seen from iron condors lately, if you're trading even a high probability iron condor, is that markets will typically do this kind of thing to finish off a trend and knock you out of the call spreads or make you adjust the call spreads. And then just as soon as you do that, all of a sudden they correct and come back down and knock out the other side. This is a very, very frustrating environment for credit spreads right now for iron condors that are purported to be high probability iron condor, because you're playing so close to the money because of IV. IV is net very low right now. With a VIX of 13, you're not getting any kind of distance on your legs right now. So unless you're really, really good at being able to extrapolate entries and leg into each side one at a time, you're getting no distance whatsoever. And that means no sleep. So honestly, I have not been doing these for a number of months now. It's just not safe to do it. Even if you're trading out of the money vertical credit spreads, you know, the individual components of an iron condor, again, like I said, you're often seeing the upside squeezes before reversals. So markets will tend to do this kind of thing. They tend to form the same kind of, you know, after a correction, they come strong off the bottom. And we're seeing this very, very different type of price behavior over the course of the last 3 years, in that we're drifting to the downside. We're exploding off of the bottom in a V bottom. We're actually rallying faster than we are correcting. Find some other time in history where you've seen that other than the last 3 years. And so what these end up doing is kind of pulling sideways a little bit and then squeezing to the upside to finish off. So we're seeing the same kind of character on every single one of these moves, okay? And it's making it very difficult. Just when it looks to be safe to do an out-of-the-money credit spread, you get run over. These are not fun to trade these days. There's just no distance. There's no implied volatility to be able to jack up the chain. So credit spreads are also short vega. Even if you do get the timing right, all of a sudden the implied volatility jumps straight up. And even if you get the timing and the direction right, all of a sudden you find the trade underwater because the implied volatility has jumped up. Okay, you can't win for losing. So these are the challenges to the typical option strategies out there. So question is, why don't we use these characteristics to help the trade? Let's put the right strategy in play for the right type of market character. So this is where a time spread can help us to sell premium in a low volatility, high risk environment. So just a quick word here on time spreads. Hopefully this is a review to most of you. What is a time spread? How can we use it now? So it's an option spread that has a difference in time between the individual options. So if you think about something in a chain, you're going to be selling something which is going to be, you know, if these are the puts here, or excuse me, the calls, and then the puts over here, you're going to be doing something, maybe this is like 10 days out, and there's going to be a difference in time versus the back option that you're going to be going long on, which is maybe, let's just say this is 20 days out or something like that. And you're going to be selling these and buying these. This is a typical time spread. So there's a time difference between the two series that you're using to form the spread, unlike a typical vertical spread where you're just going to be picking different strikes within the same option series. Now, what's the edge behind this trade? So if you've been around trading options for any length of time, you've seen something similar to this, right? So if you have an option which has got to be a short-term option, right? So let's just say that maybe this is expiring in, let's say, 7 days or something like that. So what you're going to find is that time value the value of that option is going to decay at this level, right? So you've seen that 100 times before. Now the difference is that if we have an option, if we form a time spread here, and here's the back option, here's the expiration for the back option, that's out here. What's going to occur is going to be a little bit of a difference between the two, but this one's going to remain fairly flat until this one also dies. And so the main edge that we're looking at here is kind of this differential between the two, is that the back option is going to remain relatively stable in terms of the time value decay, but the front option, whether that's front week or front month, whatever have you, is going to erode at a much faster rate. So this is the general edge behind this type of strategy, behind a time spread. It doesn't matter what kind of time spread that you use, it's all going to have this same edge. This is fixed. This is like the sun comes up tomorrow morning kind of thing. So if we build one of these, if we go to build one of these, let's just say that we did something like this, that we set up a short call that's going to be relatively at the money. So these are on the spiders. And so we sell the 25 November, which is next Friday, right? So it's a week from now, Friday. I think it is, right? And then we go out another week to the 02 December. That's going to be at the same strike, and that's a long call. So this one's short, and this one's long. Okay, so this is going to be a net debit to set up the trade, because what you sell, the short call that you sell, is going to have less value to it than the back call that you buy. All right, so this is a very typical looking calendar spread type of, and here's the max risk. That's the debit that you pay. All right, and here's the unattainable profit peak. So what we're looking to do on a trade like this, just get some, get our fair share. And so obviously, just looking at this trade, you'd want to set up something like this if you felt that if a short-term period, the price was going to stay within a relatively small range here, within here, okay? Sometimes we can set these things up, and they can be a very effective trade if we get into a stair-stepping type of arrangement, right? So if we see these break out and then stair-step, breakout, stair-step, a calendar spread like this can be a very effective tool for something like that. All right, and this can be a replacement for an iron condor. This can be a replacement for an iron condor in low volatility environments to do something like this. But boy, do you have to get a lot of things right to set up one of these trades, because the reward up here is much smaller than the risk down here. So if you step into a big move, it's, you're not going to be happy about these types of trades. So it's very, very precise parameters to set up one of these trades so that you get yourself into a good situation. But that's a typical time spread. This is a calendar spread, right? This is a typical calendar spread. And what makes a calendar spread is that generally the strikes are going to be the same. Generally, you're going to be using the same strikes. Okay, remember guys, I'm not checking the question box here. I will take questions at the end of this session, which is not going to be that long from now. I'm going to go pretty quickly here. All right, so a diagonal spread is one where you have different strike prices. So it's going to be a time spread still, because you have a time differential between what you sold and what you bought, but we're using different strike prices. So what I've done is I've shifted the long option a little further out of the money, so we end up getting a credit here. We get a credit here. Okay, this is cool. So we're starting to get to a place where we want to, because how much downside risk does this trade have? Well, zero. We have zero downside risk. This can go to zero Not that we want the S&P 500 to go to zero, but if it did, I mean, we'd have much bigger problems, right? But regardless of what stock that we set this up to, it can go down a lot and we're not going to care, because that credit that we receive is what we keep. So the thing basically expires worthless. It's just like a vertical spread. Okay, here's the problem with this thing though. I don't like this. So good idea, but in today's world, I'm just not a big fan of these high probability spreads anymore. This is all I used to do once upon a time, was these high probability spreads. But in today's world, in today's QE world, this is a recipe for losing sleep. I guarantee it. So what we're going to do is give it one more tweak to this diagonal. What we're going to do is place this dude right at the money, So what we're going to do is essentially we're going to create a one-to-one reward to risk trade on this. What we're seeking is essentially what we're risking on here. So we still have a diagonal. We still have a diagonal because we have different strikes, right? We still have a time spread because we still have a time differential. And now we have a trade that brings in a pretty decent credit, okay, and gives us a decent reward to risk ratio. Now, you could set up this trade just based on trade logic alone, saying that, hey, we have, one standard deviation. There's a 68.3% chance that the price is going to swing up, swing down, and in just basic movement and just basic realized volatility over the course of a week or so, we'll probably find the price stumbling down here that we can take this for a profit. Okay? So for those of you that are random walkers, for those of you that follow Burton Malkiel, great. You can set it up this way. You can trade this whenever and however you want to, and then the chances are pretty strong within the course of a week or two, if we hold this thing, that the price will fade back down to here. You'll be able to take it off for profit. Okay? That's great, but that's not good enough for me, because I'm a technical analyst, and this is what I do, is that I have this strange feeling that we can do something to increase the odds on the trade. Okay? So let's pull back for a second. What did we just create? We did create a bearish spread, didn't we? We have zero downside risk for the trade. It is long theta. Long theta means that it burns off time value every day and works in our favor. This is good. This is what we want. It's also long vega. Remember that discussion that we had on vega? Sensitivity to rising implied volatility. It wants implied volatility to rise. That's good. So this means that all the forces align for us. If the price drops, NIV normally will rise during something like that. This also means that everything is aligned against us if the opposite occurs, right? So if the price continues rocketing higher, it's going to work against us in the same manner. That's okay. So on large moves up or down, the risk is fixed. The returns will be somewhat variable at the money. So again, if I go back to here, the returns at the money on something like this are going to be very, you don't want to take this thing until the very last 5 minutes of expiration, and then you're going to see, obviously gamma, moving the thing around quite a bit. So you want to get your fair share. You want to grab your profits as they become available to you. So what is the edge behind this trade? What is the edge behind this trade? There's a defined edge of time decay of the front option to the back option. So we talked about that in that one diagram that I drew out. So another variable that we can use as an edge if we manage this correctly is the fact of vega. Right, so vega implied volatility will rise as the price goes down. I mean, just like the sun comes up tomorrow morning, if price goes down, implied volatility net goes up. So the trade will be very sensitive to IV rising after entry, particularly in the back option. Back option has more vega. So we can potentially earn more than the initial credit on the trade if we see the right volatility differential. Now this is unlikely, but let me show you what this means. Okay, the area in between, kind of the flat area here, that goes from here down to here. Okay, so everything outside of this will not change. This will not change at expiration. This will not change at expiration. This represents the maximum debit. This represents the credit that you receive, right? So this represents the loss, and here's the credit. Now, everything inside of this is fair game. This may be news to you, but expiration graphs change with changes in implied volatility if you're trading a time spread. So what you can see is you can actually see if implied volatility jumps up after you enter, you can actually see this change and do something like this, right? You can actually see it change. So if the price drops from the entry point, the increase in IV will help swell the profitable zone. Now, the converse of that is that it can actually shrink it. If implied volatility drops, this will actually shrink a little bit. So you'll see this kind of, you can especially see that in a calendar spread. A calendar spread will go from something like this, and you can see it shrink to something like this, which is just above the zero line. So a diagonal, this is actually not quite as bad as a calendar spread in terms of that. But I've seen this grow quite a bit. And again, we're never ever going to take a trade all the way up to this profit peak. It's never going to happen. We're going to see the price come down. We're going to get our fair share as it gets up to the profit target. We're going to walk away from the trade. No regrets. So there is a certain edge to this. Now, what is the risk behind the trade? Risk is defined by the max loss on the risk curve. So risk is defined by this guy down here, down here, which is a ways out. How far does that have to go to get maximum loss? Quite a bit. We do not want to get in front of a persistent uptrend with a strategy. This puts us into a can't win scenario. Probably what I see, the biggest mistake that I see people make with any type of bearish trade, whether it's a vertical spread or anything else, is you get a correction and then you see at the bottom of a correction, what's everybody's mood down here? Everybody's mood is basically, very bearish at this point. And so a lot of times what you'll see is the very first rally back up, everybody that missed out on this whole move to the downside says, oh, good, here's a great place to short again. And what happens is, boom, this is what we're seeing. We're seeing just complete V bottoms ever since 2013. And so what you want to avoid is putting something on down here. You don't want to do it down here. So we'll talk about that in just a bit more in a minute. So I want to keep the strategy simple. I'm not interested in adjusting, mutating the risk curve, or doing anything else like that. So there's games that you can play with these. If I go back to the risk curve, there's games that you can play, like if the price starts to move above a certain point, you can add calls, you can add more time spreads, you can add calendar spreads to this, you can mutate it in any form that you want to. I am not interested in that. Now, if you want to do stuff like that, that's great, but I think what you're going to do is ultimately you'll end up wasting a lot of time and capital chasing after something like that. So in my world, my preferred thing to do with this is just start out with a great reward to risk on this and manage it, take my fair share, and get out, right? But it's also very dependent upon entering at the right time. Okay, we also have dividend risk. We want to be careful of dividend risk. We have sold a short call option. I don't want to be the owner of a pile of short shares if I trade this thing over the dividend by accident. So I don't want to do that. So risk is defined by the spread width minus the initial credit. So very simple. So why would you want to trade this? Why not? Why bother learning a whole new strategy? Why not just do vertical spreads? Why not do credit spreads? Why not do the same thing that you've been doing the whole time? Zero downside risk is a very compelling thing to have in the next 6 months. Zero downside risk will be a very valuable thing to have. I don't care if you don't apply this strategy, even if you do something just with vertical spreads, whatever. Finding a way to have zero downside risk means that you're going to be able to sleep. We're going to have some pretty big swings, I think, even if we do have a persistent trend. So you want to place this trade when your signals tell you that the price is stalled and is likely to pull sideways to down. This should also coincide with the rise in implied volatility, as I've made before. So if you time these trades well, you'll see a multiplication of edge. There's very few times where you actually have this multiplication of edge. You can see it if you buy a long put option at the top of a rally, right? But how often are those going to work out? Right? Those are not as easy. Those look great on paper, but it's very difficult to do. A spread gives you a chance, many chances to win. So for those of you familiar with the in-out spreads, if you've followed TheoTrade or Don for any length of time, you'll recognize the in-out spreads. This is a very similar trade to the in-out spread, but it's got a little bit of a kick to it. So I would say this is a slightly more advanced trade. It's a slightly more complex trade because there's a little bit of an edge to it if you time them right. So if you just trade this on the spiders or the IWM, then you'll see strong opportunities for this fade probably every few weeks or so. So that's not a bad place to start, is just to focus on the spiders. And then when the spiders are paying a dividend, then you switch over to the IWM. And then when that pays a dividend later on in the month, then you switch back over to the spiders. You can, kind of get into a groove here and keep looking for the opportunities, but you'll probably say, hey, I'm just not getting enough trades. So these are worth waiting for, but we can cast a wider net, wouldn't you? So we can use automated scanning technologies. And this is the fun part here because, again, I come from an old school where my mentor for teaching charts used to get a book delivered to him on the weekend with about 3,000 charts in it, would sit there and speed scan through, literally just like take 2 seconds to look at each chart and look for the right patterns. And we just don't have to do that anymore. We don't have to spend a whole weekend looking through a book for something like this. We can let the system do it for us. So we want to identify charts that have rallied strongly and are just about to fade lower. So you might be thinking, well, let's use an oscillator for something like this. Let's use an oscillator. And those can be good, but very honestly, I find that oscillators are much better for finding bottoms than tops, because tops are a process and they can go much further than you would expect. What is overbought can remain overbought beyond any form of reason in today's market. Right? I think you guys would agree with me on that. So I have personally found something that's inherently more accurate, which is fractal energies. If you guys have heard of me, if you've followed anything that I've ever done, this is primarily what I'm using now, is fractal energies. Fractal meaning I'm using different time frames. Energy meaning that I understand the potential energy of each trend based on the linearity. So I use multiple fractal time frames. They're separated by a factor of 5 from each one. So I use the same factor of 5 regardless if I'm day trading or swing trading with monthly, weekly, daily charts. So I understand the linearity of the trend at each time frame. What on earth is linearity of each trend? Okay, this is a good example of a linear trend. It's if you can stick a ruler on it and measure it, then you've got a linear trend. And you can think of this as a kind of a fuel gauge where you've got full and you got empty down here. All right, so what's empty? Empty means it's going from range expansion to range contraction. Range expansion, range contraction. Goes back and forth between those two phases. Right? So it's just a very simple way to look at things. So range expansion leads to range contraction. So here's range expansion, and it's leading to range contraction, which is over here. Range expansion, range contraction. Okay? And then range contraction leads to, here's range contraction, is going to lead to range expansion again. Range expansion. It just goes back and forth between these phases. Rinse and repeat, my friends. So this expansion contraction cycle continues indefinitely. It never stops. All you have to understand is what's going on. So don't think about things anymore in terms of overbought and oversold. That was from the 70s. Overbought and oversold was from the 1970s. I don't think we have an overbought, oversold market anymore. I don't think it works like that. So we're using multiple time frames to understand the smaller time frame moves that fit within larger time frame swings, okay? What on earth does that mean? All right, large swing, maybe like a weekly chart swing, right? Big swing here. I can identify the smaller moves inside of there. This is what we're trading. I can find some edge within there, okay? So looking for a swing to hit a limit of linearity on the range expansion cycle to the upside. This is going to give us a very high probability entry. Remember when I talked about how we're seeing these moves that kind of look like this? You know, where people are chasing after a trend at the very end. Everybody's thundering after something and chasing after Amazon at the very top or NVIDIA at the very top or whatever, right? This gives us a very high probability entry as we identify this. And we say, this is the point that I want to get in. This is where everybody wants to buy. Everybody is panicking, thinking that this is the very last rally they'll ever see. That's where I want to be selling this. And we don't have to babysit charts either. We don't have to sit there and watch it like every 5 minutes. Well, what I can do is I can set up what's called a dynamic watch list. I can program a scan in and say, Mr. Watch List, tell me when the scan fires out a candidate, right? And so I can get emailed and notified the instant that the scan picks up the desired pattern for the entry. This is actually an alert from a different scan that I have, which I get emailed on. So I get emailed or texted or however you want it. You know, there's actually even a little alert button that's on the thinkorswim platform. So let's put it all together. Let's build, you know, this is what I think a lot of people miss out on is that they get good at one thing, they learn a strategy, but they don't understand the analysis that goes with it, or the money management that goes with it, or the improvement that goes along with it. How do you improve something? How do you get better at something? What happens if you lose the first 2 trades that you take with it? Are you going to quit and thunder over and go find another strategy? That's how most people do it. You know, you get this thundering herd, you know, bouncing between different strategies out there. Get good at one thing at a time. How do we build a trading framework for this strategy? First off, we start with, this is what we do at TheoTrade. We start off with a trade logic to begin with. We put ourselves in the best possible position to profit and manage risk over the near term with the expected market character. The trade logic has to fit for what we're doing. The last 40 minutes, I've talked to you about the trade logic for this specific strategy. So we limit risk on the trade from the point of entry. So there's none of this crap of losing sleep at night due to tail risk. How many times have you guys been through that before where it's like, oh no, oh crap, you know, what's going on here? You know, waking up at 2 o'clock in the morning checking the futures because you're not sure if your vertical spread's getting punched through. Yeah, it was way out of the money when you put it on, but what happened overnight? Limit down. No losing sleep from these. So we also limit capital exposure through money management on any one trade to the point of we don't care about the outcome of your trade. In fact, I would go as far as saying that if you don't trade like this, that you will probably mismanage the trade because you care too much. It's like sending kids off to college. You got to let them do what they're going to do, right? You can't helicopter. And we also delay entry until we have a very high probability of the trade working out from a technical price and volatility basis. Yes, we actually put some effort and thought into when and how to enter. All the while letting the system find trades for us and not having to force the wrong strategy in today's market like so many one-trick ponies do. We're all the same. I did this early on in my career. I was an iron condor trader, and I was going to do iron condors until I die, until you run into a market that does not support iron condors. Then you're banging a square peg into a round hole. You have to adjust. You have to understand what the market is giving you. It's begging us to listen to it, to tell what to trade. Okay, so what are the exact specifics behind this strategy? Well, this is where we get into the recipe in trading. And this is where we love specifics. So trading is about answering the what ifs. It's not necessarily just following a sheet. It's understanding, what if this happens? How many times have you learned about a strategy and then you go to trade it on your own and all of a sudden you feel lost because nothing makes sense anymore? So how do I evaluate this study in multiple fractal timeframes? What makes a good signal? How do I interpret the signals in the context of price movement? How do I create a scan against this study? How can I filter out only the highest liquidity stocks, or am I going to be looking at candidates from Joe's Ugly Shirt Company, right? How can I improve the probability on my scan results? How can I make sure that everything that comes out of that scan is going to be worth trading? How do I enter? How do I defend the position? How do I exit it? How can I be notified when my scan produces a result? How can I create the same framework that TheoTrade uses, right? We've been doing this for long enough. We don't have to reinvent the wheel. So we do have your answers. We have the answers to your trade-related questions. We build recipes. This is what we do. We specify criteria. We also, as Bill O'Reilly would say, we do it live every day in our chat room. This is not something that we do as an academic exercise. We trade live in our chat room. We communicate the trade. We say why we're doing it. We send it out to every member. This is what we do all day long. So we get into the how, when, why, and what signals. This is just the beginning of the many variables that you'll face. So hopefully tonight you guys have gotten a sense of what you should be doing, what you can be doing. Maybe this is something new for you. Well, what you're going to find is that as you look at the market tomorrow morning, you're going to go, oh, well, wait a minute. When am I supposed to, what spread with, what credit, what, all this other stuff, right? So the secret's in the sauce. You know, you can probably find an article on the internet on how to do something like this, but you're not going to have the details, guys. So we've spent years adapting this to our trading. So the question for you guys is, would you like the criteria to add this analysis framework and strategy to your trading? People love it. So with that, we are going to do a class this weekend, and yours truly is the instructor. You'll get access to this. It will be available to you indefinitely. You can rewind it as many times as you want. And what's actually very cool about this is that the guys have made all these bonuses available to you for one small fee. So Options 101, this is a Don Kaufman class. Options 201, Don Kaufman class. Each of these is 5 parts, 5 hours. This alone is 10 hours of instruction. And then you've got my 5-part, 3.5-hour fractal energy trading. Plus you get the scans and the studies for thinkorswim, $97. You're not going to find a value like this anywhere else, right? So the diagonal spreads for income, the curriculum, is we're going to go into a little bit of the theory about why the trade works, and how to maximize the edge for this. We're going to go specifically into the entry criteria for the trade. We're going to understand how to manage and exit it. And here's actually a very important point that I think a lot of people that have taken classes with us have come to appreciate, is that we do the sample trading plan. We actually work through this live and show you how to do the Pareto-based logging framework. So the whole idea here is that, look, the first couple of times that you do this, you may have trouble doing it, right? So you may not get the result that you want, but we show you how to make the adjustments to improve so that the next time you do it, maybe you're one notch up. And as you keep doing these things, you're improving every single time. Look, I'm tired of you guys. You know, we all do this. We all do this. We learn about something, we trade it once or twice, and we maybe don't profit from the trade. So we go thundering over here and try something else, some new bright, shiny penny over here. You know, I'm tired of us wasting money as retail traders. We waste so much money at this. This is the key right there, understanding how to set up a logging framework. And then, of course, we're going to do examples and live scans. We're going to do everything live in the class. Okay, so would you like access to this class, or what about every class we've ever done and every class we will do for the next year? So if you want to, you can join us for a full year, which is only $9.97. So if you take this class this weekend and then you decide, man, that was good, I want everything else that you've got, you can apply that as a credit towards this package here, $9.97 for a full year. You're not going to find anything like it with the amount of content that we have. In fact, let me just show you this real quick. This is what our chat room looks like. So this is our current chat room here. And so some of the archives, you can see we run the chat room 24 hours a day. There's people in there 24 hours a day. They're from all over the world. You can also go down to the archives. We have archives from Jeff, Slim Miller, myself, Don, member classes. These are all the classes that we've given over the last year. Look at all these. Each one of these is going to be at least 3 hours long. Each one of these is 3 hours long. There is an incredible depth of information that's out there. So not only that, but I think one of the biggest benefits that most people find with joining is the fact of community. The community that you get from being part of this is that you've always got somebody that you can talk to. You can ask us questions. You can ask questions to other people in the room as well too. So with that, my friends, this is about the time I had intended to throw it open for questions. I will take whatever questions that you have at this point. So let me know what I can help you with at this point.